Right now, thousands of people are making millions of dollars, buying and selling millions of barrels of crude oil, tons of wheat, and coffee beans, without ever physically touching a single one of them. Most people think the stock market is about buying pieces of companies today. But the largest, most critical financial system on Earth is actually a giant time machine built to trade the future. By the end of this video, you will understand the hidden legal machinery running global commodity markets, how Wall Street uses a single piece of paper to shift billions of dollars in risk, and why a storm in Brazil can instantly change the price of your morning coffee before the beans are even grown. Welcome to What Actually Is. Let's start with a simple problem. Imagine you're a baker. 6 months from now, you're opening a new bakery. You'll need massive amounts of sugar. But here's your nightmare. What if sugar prices spike? You could go bankrupt before you even open the doors. Now imagine you're a sugar farmer on the other side of the world. In 6 months, your fields will produce thousands of tons of sugar. But you're terrified too. What if prices crash? Your entire year's profit vanishes overnight. Both of you are trapped by the same problem: time and uncertainty. This is where the futures contract enters. It's not fancy, it's actually genius in its simplicity. A futures contract is a legally binding agreement. Here's what it does. You lock in a price today for a delivery that happens months in the future. The baker and the farmer shake hands on a contract that says, "I will sell you 10,000 tons of sugar on December 15th for exactly 25 cents per pound." No negotiation on that date. No surprises. The price is frozen right now, on paper. The baker sleeps soundly. His sugar cost is locked. He can now plan his budget. He can build his factory. He can set his menu prices. No panic. The farmer sleeps soundly too. He knows exactly what he'll earn. No price collapse can destroy him. This single mechanism, this paper contract, stabilizes global infrastructure. Refineries can build pipelines. Airlines can order jet fuel. Coffee roasters can plan next year's operations. All because futures contracts kill the terror of tomorrow. The global economy doesn't run on spot prices. It runs on futures prices. It runs on certainty. Here's where the story gets interesting, because the baker and farmer aren't the only players. Imagine a concert venue. Tickets are selling for $50. A fan wants to go. A scalper wants to profit. The fan buys a ticket because he wants to sit in the seat. He wants to experience the concert. He's paying for the actual thing. The scalper buys 50 tickets for resale. He doesn't care about the concert. He's not going. He just knows that demand is rising. In 3 weeks, these tickets might be worth $200 each. He buys them today for $50 and sells them later for profit. Same ticket, completely different reason for owning it. Futures markets work exactly like this, except instead of concert tickets, we're trading commodity contracts. The farmer and baker are like the concert fan. They're buying and selling the actual seat. They actually need the commodity. Wall Street traders are like the scalper. They own the contract, but they don't care about physical sugar or oil or wheat. They never will. They're trading the mathematical value of the paper itself. Here's the shocking truth. 99% of all futures contracts traded globally never result in physical delivery. No actual oil tankers arrive. No wheat gets bagged. No coffee gets roasted. The contracts just change hands, over and over, thousands of times per day. Traders are making millions buying and selling contracts purely based on price movements. Buy at $50, sell at $55, repeat 10,000 times per day. Pocket the difference. You might think this is parasitic. It isn't. Here's why. These speculators inject massive liquidity into the market. They provide the other side of every trade. When a farmer wants to sell his future wheat, a speculator is waiting on the other end, willing to buy it. Without these speculators, the market would freeze. Farmers couldn't hedge. Refineries couldn't lock in costs. The entire system collapses. The scalper isn't evil. The scalper is essential infrastructure. But here's the financial sorcery that makes this machine possible. A trader doesn't need $5 million in cash to buy a $5 million oil contract. Think of a security deposit at an apartment. You want to rent a $2,000 apartment. The landlord doesn't ask you to pay $24,000 up front for the year. He asks for a deposit. Maybe $2,000, maybe $3,000. That deposit holds the apartment. It proves you're serious. You control the full value with a fraction of the capital. Futures work identically, except the deposit is called margin. A trader wants to buy a crude oil futures contract worth $5 million. He doesn't have $5 million, but the exchange says, put down 5% of that, $250,000. That's your security deposit. You now control the full $5 million contract. This is leverage, and it's explosive. If that oil contract rises 10%, the trader makes $500,000 profit on his $250,000 deposit. That's a 200% return. Massive. But flip it. If that contract drops 10%, he loses $500,000. He's wiped out, and he still owes the exchange. This is why traders panic. This is why they're desperate. When markets move against them, they can lose multiples of their initial investment. Leverage works both directions. Millions of barrels worth billions of dollars are being controlled by traders with fractional capital. Most of the time this works. Markets stay stable, contracts settle, everyone profits or loses proportionally. But when a true shock hits, a storm, a war, a pandemic, leverage becomes a chainsaw. Traders start getting demolished. Margin calls arrive. They're forced to sell at any price just to survive. And everyone downstream feels that earthquake. Just like commodity markets need speculators to inject liquidity and keep the gears turning, a growing educational channel needs a steady stream of viewer engagement. Hitting the like button, subscribing, and dropping a comment acts exactly like a liquidity injection for the YouTube algorithm. It signals to the system that this data holds value. If you're finding clarity here, consider backing the engine. Now, back to the markets. The market has a rule, a law actually. Every futures contract has an expiration date, a countdown clock. When that clock hits zero, something wild happens. Imagine a Wall Street trader sitting in a Manhattan office. He bought 10,000 barrels of crude oil futures on March 15th. He's been flipping the contract for profits all month. Buy low, sell high. Beautiful. But it's now December 13th. The contract expires tomorrow, and he's still holding it. He never intended to hold physical oil. He's a financial trader. He has no tanks, no pipeline, no refinery. But the rule doesn't care about his intentions. The rule says, tomorrow at 9 a.m., maritime tankers will legally arrive at designated delivery points. Thousands of barrels of physical crude oil will be unloaded directly to whoever holds this contract. Imagine a panic. A real, sweating, phone-throwing panic. The trader has maybe 24 hours to offload this contract. He has to find someone else to dump it on. Fast. Who buys it? An actual oil refinery, or a shipping company, or an airline. Someone who actually needs oil and can take physical delivery. The trader frantically offers a slight discount to seal the deal. $2 cheaper per barrel to get it off his books. The refinery takes it. The contract changes hands. The countdown stops for that trader. His office stays empty of oil tankers. This is called rolling the contract or offsetting positions. The hot potato passes to someone else. But sometimes the hot potato has nowhere to go. And when that happens, the market breaks. April 20th, 2020, a Monday. One of the most bizarre days in financial history. COVID lockdowns had just slammed the world. Factories closed, flights grounded, cars stopped moving. Global oil demand collapsed overnight. Refineries had already filled their tanks weeks earlier. Now demand was gone, but the oil kept flowing. Physical storage tanks around the world were full. Not 90% full, completely full. Maxed out. The May 2020 crude oil futures contract was expiring that day. Traders still held millions of barrels worth of contracts, and they had nowhere to physically store the oil. The panic was absolute. Refineries weren't buying, storage was full, shipping companies weren't taking delivery. No one wanted oil. There was literally nowhere to put it. So traders did something that had never happened before in modern financial history. They paid people to take their contracts. Oil went negative. Negative $37 per barrel. Traders were literally paying $37 per barrel to offload the contracts before physical delivery trucks arrived. Think about that. These traders had paid money to buy the contracts at positive prices. Now they had to pay again to get rid of them. Billions in losses in a single day. Why? Because holding the contract meant tanks full of physical oil with nowhere to go. Paying someone to take it was cheaper than the storage costs and legal liability of refusing delivery. This was the hot potato at its ultimate extreme. The countdown clock hit 0. The delivery mechanism activated. And the entire system seized up because the physical world couldn't absorb another gallon. The financial abstractions snapped right back to earth. But this hidden legal plumbing doesn't just crash Wall Street portfolios. It quietly dictates your everyday life. Tomorrow morning, you might walk into a cafe and buy a coffee for $5. You'll think that price is based on the beans on the shelf today. You'd be completely wrong. The global coffee price isn't set by what's on shelves right now. It's set by what traders think will be available 6 months from now. A storm hits Brazil. Coffee plants are damaged. Harvest might be 20% lower this year. Traders see this news. They look at December futures contracts, coffee beans that won't be harvested for 6 months. They predict a shortage, a massive shortage. Suddenly, thousands of traders are buying December coffee contracts. Bidding wars erupt. The price of next month's tickets skyrockets. Within hours, that price movement ripples through global markets. Importers see it. Roasters see it. Your local cafe sees it. Your $5 coffee is now $6.50. Not because coffee vanished from shelves, but because traders are betting on scarcity 6 months away. This is the invisible engine of global prices. The futures market is a giant mathematical prediction machine. It's trading time and risk on paper, years before those risks become reality. The global economy doesn't run on what's here today. It runs on what traders predict will be here tomorrow. A Brazilian storm changes your morning price before the beans are even grown. That's the mechanism. That's the power. But futures markets are just the beginning. There are hidden mechanisms running the world that most people will never understand. In our next video, we're pulling back the curtain on another system that shapes your life in ways you don't even realize. Subscribe so you don't miss it.